Let's turn to our first guest for the hour. We've got Tony Minopoli, Knights of Columbus Asset Advisors President and CIO. Tony, let's start with some of those comments that we got from Raphael Bostic over the weekend, sort of floating this idea that the Fed could be much more aggressive. How are you looking at that trajectory right now?
Well, good morning, Akiko. Thanks for having me. No, we are looking at that. And I guess I'm old enough to remember that last 50 basis point increase back in 2000. We think the Fed's going to be in line for probably 4 or 5, but we are telling our clients, we're telling our investors, do not rule out a 50 basis point hike. And part of this is that what's causing the inflation that we're having in the market, we've not been in the transitory camp because if it's wages, it's energy prices, it's the continued kinks in the supply chain. These are things that are not going to be solved in a month or two. We think these are with us for the rest of 22 and maybe into 23. And I think the Fed's trying to get ahead of it. And those comments about the potential for an inverted curve, certainly it's something that we're keeping an eye on, but we actually think the inflation's in the system may see more of a parallel shift with the curve moving just upward as opposed to just the front end being fulcrumed around maybe the 5 or 10 year. So a lot to unpack for the moment.
Specifically on those price pressures you alluded to, we're already at a 40-year high when it comes to CPI. How much higher do you think that goes?
Well, it's not as much as does it go much higher. It's that we just don't see it coming back down into that sort of 2 to 2.5% range where the Fed was being more comfortable. I'm definitely in the camp that energy prices are going to stay this high for a bit. You've got some folks on Wall Street now calling and saying, look, we could see $100 oil. And with what's going on just in the energy complex, giving the political tensions now with Russia and the Ukraine, it's going to push natural gas prices up higher as well. So there are pressures. We haven't really had to deal with geopolitical issues in a major way. Not that we haven't had geopolitical problems, but geopolitical issues weighing consistently and so heavily on the financial markets. It's been quite a while. And if any action happens within the Ukraine, we certainly think you're going to see energy prices just across the board, natural gas and oil increase. But I will add to that. I think you're not going to see anything, if anything happens, if diplomacy doesn't win, we really don't think anything is going to happen until after the Olympics because Russia has been trying to remain friendly with China. And I think it's quite possible that they're not going to look to disrespect their friends in China by taking an action during the Olympics when China's going to really want to shine as much as they can.
Tony, specifically on oil, when you talk about prices potentially reaching $100 a barrel, does that factor in a potential Russian invasion of Ukraine, or is that even without that?
I think it's even without it because we've got supply constraints and demand is definitely coming back. I just was able to sneak away for a few days to Florida last week to try to enjoy some warmth, and airports were full, roads were full. So we're definitely seeing the demand side. And as you know, in the U.S., we've had the XL pipeline, and not a political statement, but that pipeline's not being built. We've had more challenges in terms of drilling on federal lands or getting drilling leases. So it's causing a scarcity. Man-made perhaps, but it's causing a scarcity that certainly is causing upward pressure on prices. And as you know, once this starts, it can begin to feed on itself. So we think it's not going away anytime in the short term, and that's feeding into that potentiality for 100. Certainly, if you have military action, and if Russia does cross the line and there's a full-blown incursion into the Ukraine, I think that could put even more upward pressure on oil, which is going to put even more upward pressure on inflation.
You said that you were advising your clients not to discount a potential 50 basis points hike when we're talking about the year. What does that mean from a strategy standpoint? Does that mean a big push into value, or do you tell your clients right now, just kind of stay put until things shake down?
Well, we have been talking to clients. So we with our clients, we basically develop two sets of models. We have strategic models that are meant to be 5 to 10 years. Then we have tactical models. And on the tactical side, we are looking at growth at small cap and at international, maybe as being better places versus longer dated bonds and growth stocks. And energy, consumer staples, those are areas that we think can continue to do quite well. Obviously, energy's had a great run in January thus far, but we still think if prices are going to be stabilizing here or even increasing a bit, they can have some room to roam. Finance, again, there's still a lot of good stuff going on with banks. If you've got rising interest rates, it's going to help their net interest margin. And certainly consumer staples, we think are a good place to be right now, particularly as we have, yet another, is there a potential variant behind Omicron, Omicron 2.0, does that cause more of a delay returning to work and more work from home, people concerned about going out, which may cause things in the staples side to be better places to be. So those are some of the things that we're looking at, and certainly some of the things we're talking about tactically with clients right now.
What about tech? Are you in the camp that, given the declines that we've seen this month, you go in and buy the dip on some of these opportunities, or do you think there's further downside, especially when you consider the jitters around higher rates?
My view on tech is basically pretty simple: wide moat and tall walls. With interest rates starting to increase, so many of these tech stocks did well, fueled on the back of, the theory of there was no alternative, or there is no alternative, the Tina theory, as well as the low rates really propelling some of these stocks. So if you've got some tech stocks trading at pretty sporty multiples, but don't have a reason for doing well, those are the stocks that may not perform so well. Apple, I always like to quote on Apple, rarely first with an idea, but often best, right? They didn't come up with the MP3, but look at the iPod. They didn't come up with cell phones, but look at the iPhone. Same thing with tablets, with the iPad. So they will continue to innovate and drive demand. But then you look at a company like Netflix, if the content expense continues to increase, it's going to be very difficult. So they've got to drive subscriber base on the one hand, so they've got to draw top line, and they've got to help manage their bottom line when at a time everyone's competing for content, right? Streaming services, Fubo TV and all these different streaming services that are out there, the fight for content is going to continue, and that's something that could be a headwind for a stock like Netflix.
Tony Minopoli, appreciate you stopping by on this Monday. President and CIO of Knights of Columbus Asset Advisors.